Hey folks, Tuesday, 3rd of October 2023, and we are back on the market. So I was off yesterday, took the day off, and we're back this week to a lot going on, really. We have pretty busy slate, so we're gonna get through that straight off the bat here. And so yesterday we had ISM manufacturing coming in there. The PMI is coming in hot and not 49.0, above forecast 47.7. So coming in nice and hot there. But really we saw, sideways barcoding action in equities on the back of this. The market's in a really tricky spot where it kind of doesn't know which way to go at the moment. But, net net, I think she's going down. But we'll get onto that in a second. Nothing really coming out of Powell's speech last night. Wasn't really going to be too hot on the economic situation anyway. But today, Jolt's coming in at 3 o'clock GMT in the US, and then we're going through to Wednesday. Of course, we're going to have ADP non-farm employment change as we have NFP this week. That's set to come out 160,000. The PMI, services PMI, manufacturing PMI is also to come there. And then crude oil inventories, which we will talk about at the tail end of this session. Thursday, initial jobless. And then, of course, Friday, it is Super Bowl for traders. The non-farm payroll is set to come out 163,000. There's going to be a bit of a spread, as always, between the banks as to their expectations here, but we're looking at generally about 163. Looking to add a lot less jobs, really, than, a couple of months ago here. But generally, the economic outlook is for a soft landing. And, the problem we're seeing with the bond complex at the moment, it's kind of tied into, the market. And I joked about this with Jason, the guys in the room as well, that the market was really expecting some cuts, right? So some rate cuts this year, which was absolute horseshit, basically, if you ask me. No one was listening to Jerome Powell or the Fed members. And now we're in this shocker where the yields are going crazy. Anyway, we're going to get onto this. So let's look at the slate for the week. So really the big one, I think Thursday, Friday is going to be pretty decent. And there's a lot going to pivot around this NFP number, I think, which is really important. Now we're in this sort of bond situation right now, okay? So moving through, one of the big news items that is hitting the markets this week, well, it's not hitting the markets, but it's really taking effect in the US, is that federal student loan repayments are now due for the first time since the pandemic. Okay, so that's a huge sort of a financial shift in the market in the US. Now, this isn't really a global market impact here, but I just thought it was interesting, and you definitely have to note this. So I'll post the links to this article, and just looking at some of the stats here on kind of debt in the US. Obviously, the Fed with their $8 trillion balance sheet right now and set to go higher is this big green chunk here. Then you've got state and local, municipal bond sort of stuff just above that here. Might be able to zoom in a wee bit. Yeah, we're going to look at the spread like this. And then, I can't actually see. No, we'll zoom back out. And then you've got domestic debt, then no, this is your credit cards and all that. Or sorry, not your credit cards, but this is household debt and all that sort of stuff. Then your non-financial corporate, and then mortgage payments, and then you're into student loans up here. And this is why it's not a huge, big deal. And then motor vehicle loans and credit card debt above that. So kind of looking at the Fred data on this, it's really kind of looking at as a percentage of GDP. So you're really seeing here that, securitized outstanding. Yeah, the outstanding amount is something like 1.7 trillion here. Okay, and then as a percentage of US GDP, this thing has skyrocketed since 2009, which we're looking at the red line as a percentage of GDP. See here, so you're looking at it's coming in about what 7.9% of US GDP total, where it was around 2008. It's about 4% of GDP. So this is, it's a big deal for the US, right? So here's a breakdown of the balances. You're seeing the largest balances between $1 and $10,000. No biggie. Um, it goes up to probably, the second highest there is, 10 to 25,000 in red, and in green, 25,000 to 50,000. So, I'll post links to all this out there on this video in YouTube if you want to have a look at that. Just thought it was quite interesting. Okay. So oil now, we're having a pullback in oil. And, I was talking about this, the world, my mother was getting long this stuff over the last really 5 trading sessions last week. Was very frothy on the upside. Some really good constructive gains for oil, but I just think at that rate it was just a little bit unsustainable. Do I think we can't go higher? No, I think probably this week we will make a run to maybe go higher. Well, whether we'll put in a new high on the year or not, I don't know. But I do know one thing: I'm going to be trying to pick a little top for the next week or so. This week, so I'm going to be looking to try and get into a nice little short. But generally for a swing trade, but generally on the day sort of time frame stuff, I'm agnostic. Long, short, sideways, I don't care. So, the big culprit here, that they're trying to blame for oil coming on a pullback is obviously the dollar, being incredibly strong over this sort of rates, higher for longer sort of rates concept, which it's a reality, and if you paid attention to the last FOMC meeting and listened to Jerome, that's the way it is. So, do have a read here of this article. It's kind of setting out some of the dynamic prices, but really, I would not get married to this concept that this stronger dollar is so strong that it's the cause of the pullback in oil. There's a lot of other structural dynamics going on around this time of year where refiners and producers are sort of balancing up books for for the final quarter, and so they sort of net the commercials become a lot lighter on their longs, if you like, for the final quarter of the year. And then when we come into December, then they sort of kind of ramp up again as as we're then going to be trading the January 24 contract. Okay. So there's a couple of dynamics under the hood there. Okay. Another thing here, they're talking about tech kind of being spared during this bond sell-off, which I get. I think, yeah, the stonkers will never stop wanting Tesla. Um, I think there's quite a bit of value there with AI, this emergence of AI, but it is sort of the big seven, and they are tech, mainly tech, propping up these markets right now. Okay, so I think it's breaking down. So this is a really good article to kind of read inside of, why the treasuries are having such an impact. And I'm going to try and explain a little bit of this to you now in a second. I think one of the better explainers is kind of breaking down Bill Ackman's trade to kind of get a grasp on why this is important, right? And so, everything is talked about in this article: gold, dollar, rate, bonds. It's all in here. So if I was to read one article this week, I would definitely read this one. Okay, so have a read of that. Um, I thought this was interesting. I do like keeping an eye on the Peterson Institute website and their blog and what they're writing about. And, you know, generally when we kind of look down the length of 2024, we want to kind of have an idea of who are the winners and losers and who is going to, land the plane softly and not have a recession come around. Sure, we might have a shock on equities to the downside, but that's not going to denote there is a recession. Okay, and a lot of people get confused with that. They think the market is the economy and the economy is the market. It's very much not the case. And so we could easily have a 10% pullback now on equities, 12, 15% pullback on equities from where we are right now, and avoid a recession. So what this article, this blog post really looks at is really looking around the world at where they're pegging GDP to be by the end of 2024. And they're looking at forecasts here. So, you're seeing kind of global is going to be still pretty buoyant at 2.8. US in 2024 at 1.6. The UK coming off a really not looking good there at all. Negative zero point 0.3, negative zero point 0.2 then in 2024. That's not good, man. The mild recession appears to be taking hold, is what they're saying here. You will, all right, fair enough. Yeah, we can see that. Um, China looking pretty good, and India actually looking to weather the entire storm very well. 6.3 this year, going to 6% next year GDP, or sorry, GDP next year. And Russia actually coming out of the depths of 2020, 22 here. So, looking at being pretty buoyant by 2024. Brazil, the big darling of, well, was once a big darling of EM, and I just don't think that's a trade anymore. But a pretty interesting article to kind of look down, really have a broad look out in the future and GDP and where countries are, coming out of the shock of COVID, essentially. All right. Another article from Peterson Institute contributor Jason Furman. This now really studies how the Fed are not concerned with profits, though they were pulling in 75 billion a month from their assets. That trade has now flipped, where that was in a ZERP, a zero interest rate environment, where essentially they were reaping quite a lot of money in from their balance sheet, 75 big ones a month. But now that rates are at, I think, well, 5.25 to 5.5. Um, the 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 central bank now in the US, the Fed, are now having to pay interest to the banks who have money on deposit with them. They're paying out 5.4%. Okay. So the good times are over for making 75 big ones a month. They're going to be paying out a huge amount in coupon rates to bondholders, okay, at this 5.4. Okay, so this is kind of part of the problem, okay? And rates staying higher for longer essentially then says to the bond complex that the yields on the bonds are going to have to be matching that and higher. So if you want higher yields in bonds, or bonds need to gravitate to a higher yield, well, that means prices go down, bonds drop. Okay. So to understand this a little more elegantly, we're going to pop over and just have a wee look at two items here that are big in the bond complex. That I share is 20 plus year treasury bond ETF. So that's on your left. And then on the right, you have the yield on the 30-year government US bonds. Okay. And we'll just transition over. So here it is. The iShares 20 plus year treasury bond. So that's investing in bonds that are 20 plus years for the yield. And then on the right here is the 30-month. Now, or 30-year government bond. Now, what you're looking at are monthly bars all time for each of these markets. So let's just look at TLT on the left, okay? So you're seeing that really coming out of the high that was put in there on March 2020, just when the Fed started, we're going to start cutting and essentially, putting QE into the market there, right? Um, and then on the right here, you can see the 30-year treasury at the same time bottomed out here in what was this sort of downtrend, bottomed out when it hit that downtrend, and it hasn't looked back since. Okay. So it's now come over the 4.72 percentage yield here at this point. And this thing, I can tell you right now, I know the sun will rise tomorrow. I know I'll get out of my bed. And I know this thing is going to hit 5.265. And so does Bill Ackman. Okay. So that's what's going on with Bill's trade. So some really nice little technicals there going on. Okay. So, to come back to, well, understanding this trade a little more, there's a great article here from etfstream.com. It's kind of pegging that, Ackman is kind of going head to head with the TLT investors. I don't think that's the case at all. But more importantly, this kind of explains what Bill is supposing is going to happen. All right, and so I'd have a read through this, but essentially, I think I kind of sum it up. Well, probably not very broadly, but I sum it up kind of in a very short way to kind of say basically these longer term bonds need yields that are going to match at the least, if not be higher than the indicative um, Fed funds rate, which is 5.25 to 5.5 right now. Now, if the Fed in their November meeting raise rates, that's going to absolutely crush these bonds. Yields will skyrocket. Um, to then have to meet a higher indicative Fed funds rate. Okay, and so I just don't see this getting any better. If the Fed pause at the next meeting, I don't know. We're gonna have a few weekly look ahead videos between now and then, and I don't really think we need to get into it now. But it's basically like, don't go trying to buy, pick a bottom on these bonds because they are not ready to stop. That's basically it, right? Okay, so NFP this Friday. What would I be thinking about NFP wise? I think, if we get a big miss, like where we only add like 100,000 jobs rather than 165, something like that, like a big delta on the miss, like a 65,000 miss. Um, I think that would probably still I'd be kind of bullish for stocks, but I think that the bullishness would be quite short lived, and you could actually see stocks try and make like a new high on the week at that point, and then fall over and actually make a new low on the week. Because ultimately, I think equities are in a really bad spot now with bonds clearly having yields going to the upside. I just think the Fed can't do anything right now, to be honest, to counteract this other than QE. And if you want to kind of listen to a little bit of color on that, you look at the video, an interview I had with Jason there this week, where he kind of outlines it. Jason is, I think, uber bearish, but trying to not be. Because ultimately, look, I'm not saying it's the end of the world, but I think ultimately, these end of the world, it's just like, what's the trade? What is the trade? Tell me, okay, what am I trading? What am I buying? What am I selling? It's like it's so nuanced at the time that you just really have to see how markets are reacting at that given time and tread very carefully because I think at the moment, bonds of or sorry, equities have been trying to rally on hawk or on a little bit of dovishness, and up until we had the FOMC, last FOMC, and anyone who ever said that we were maybe going to cut rates in 2023, well, they're dead right now, and they should probably be fired because that was absolute horseshit and it was never going to happen. Anyway, I'm probably going to get blocked on Twitter or Facebook or whatever for swearing so much, but I don't care. Anyway, all right. Look, listen, guys. Be careful out there this week. There's probably easier times to trade equities. I think ultimately for us in Duggan Capital, we're trying to tread really carefully with swing trades. If you're in an equity trade and you're buying, you're in a nice, you're long the low of day, and you're liking the trade, and we just had data, or we don't have any big data on the horizon like an NFP or something. Really cash flow your trade. Like, try and bank something off. Now, this is not financial or investing advice, but I'm just kind of really wanted to talk about. You can't comfortably sit in longs at the moment, or some shorts, or some shorts either. Really, to be honest. I mean, I think gold is going to get completely wiped out. We're going to have to really come back to the 17 handle, I think, on gold before we start to see bars again here. But I don't know. It's a messy trade. But what I say it is like, cash flow yourself. Take your twos, take your 4 to 1s, and then leave your runners on, and don't have huge P&L swings here, guys. So, yeah, just be careful out there. All right. That's all from me for this week. Please do click the like and subscribe. It means a lot to us to have you following along, and thanks for listening. Don't do anything I wouldn't do. All right. Take care. Cheers.